Japan's corporate buyout boom just sent the Nikkei to 67,743, but the daily chart is screaming warning. Institutions are pumping money in, but the 5-hour and 1-hour charts are fully overbought. This is the classic divergence. The monthly and weekly are strong buy, but the daily says sell. That's where the trap lives, and exactly where my scalp setups are targeting. Japan's corporate buyout activity is in early innings, and the Nikkei just ripped 924 points higher to 67,743. But here's the thing nobody's talking about. The daily chart is flashing a massive warning. While the headlines scream bullish, the technicals are setting up one of the cleanest divergence trades I've seen this quarter. There is one danger zone and one hidden opportunity right now. I'll show you both. Look, I've been tracking this setup for 3 days. The money is flowing into Japanese equities, but the structure tells me we're at a critical pivot. The 67,743 level, that's where the retail herd is buying the breakout. But the institutional flow data suggests something completely different. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. Here's the session bias. Range bound with a bearish tilt on lower timeframes, but structurally bullish on the weekly and monthly. The single invalidation level that flips the bias? 66,805. Write this number down. If we break 66,805 today, the entire structure resets to a short bias. Let me tell you where the herd is positioned right now. Retail traders are chasing this buyout narrative hard. I'm seeing FOMO buying in the futures market. Commitment of traders data shows net long positioning at a 4-month extreme. The problem? The 5-hour and 1-hour charts are already rolling over. The 1-hour trend shows a sell signal, and the 5-hour is strong sell. This is where the trap lives. The buyout news is real, but the timing is everything. The RSI at 47.41, neutral. But the stock at 94.49 and Williams percent R at -7.45? Those are textbook overbought readings on the daily. This is a market that's exhausted after the rally. The pivot point at 67,619 is the line. Above it, we are in the buyout-driven melt-up zone. Below it, we are looking at a sharp retracement back toward the key support. Let me walk you through the chart structure from the macro down to the micro, starting with the weekly. This is where the trend tells the real story. The MA20 is at 66,816. The MA60 is at 61,687. The MA200 is at 57,173. This is a bullish structure. Price is trading above all 3 major moving averages. The weekly says strong buy, and it's been that way for months, but the daily, that's where I see the cracks. The 5-day MA at 68,701. 10-day at 69,199. 20-day at 69,906. Price is currently below all 3 short-term daily MAs. That's a bearish crossover, price respecting resistance from the 5-day and 10-day moving averages. The 50-day at 66,816 is the anchor on the daily. That's your major support. If we hold above 66,816, the longer-term uptrend is intact. But we are trading at 67,743, just 927 points above that daily MA50. Now look at the MACD on the daily. Reading at 499.77, but here's the divergence that matters. Price made a higher high in the last rally. The MACD made a lower high. That's negative divergence. That's institutional distribution. The momentum is fading while price is still pushing up. The 4-hour chart? It's holding up better. Price is still above the 4-hour MA20 and MA60. But the 5-hour and 1-hour, that's where the sell-off is accelerating. The 1-hour MACD has been flat to declining. The 5-hour trend is strong sell. Let me give you the exact levels. Key support structure S1, 66,805 S2, 66,005 S3, 65,191. Key resistance structure R1, 68,419 R2, 69,232 R3, 70,032. The ATR at 1,770 points tells me we're in a high volatility environment. That means position sizing is critical. The CCI at minus 138 on the daily, that's technically oversold. But in a range-bound market, oversold can stay oversold. The ADX at 21.67, that's below 25. This is a non-trending market on the daily. Range-bound. Here's what most traders miss: the divergence between the structural bullish weekly and the exhausted daily. This is where you make money. The weekly says buy. The daily says sell. The solution? Trade the range until the weekly and daily align. Now let's talk about why this is happening. Japan is in the early innings of a corporate buyout wave. We are seeing M&A activity surge as Japanese companies finally deploy their massive cash reserves. The Tokyo Stock Exchange's reform push is creating shareholder value, and foreign investors are taking notice. But here's the nuance. The buyout activity is concentrated in specific sectors: tech, healthcare, and manufacturing. The broad Nikkei index includes many companies that are not part of this buyout story. That's creating dispersion. The index is up, but the internals are weakening. The cross-asset linkage? Watch the dollar-yen. US dollar to Japanese yen is the shadow on this trade. A weaker yen benefits Japanese exporters and makes buyout targets cheaper for foreign acquirers. But if the yen strengthens, that narrative reverses. The yield differential between US and Japanese bonds is still wide, but the gap is narrowing. The BOJ is slowly moving toward normalization, and that's a headwind for the Nikkei in the medium term. Compare this to the S&P 500. US tech is leading the charge globally, but Japanese tech is lagging. The Nikkei outperformed in Q2, but that momentum is fading. If you're trading the Nikkei, you need to watch the Nasdaq futures overnight. They correlated, but with a lag. The 1 to 2 week directional lean? I'm neutral to bearish in the short term, bullish in the medium term. The buyout activity is real. It's going to support prices long term. But the technicals say we need a flush before the next leg up. The event that invalidates this view? A daily close above 68,419. If we break that resistance with volume, the whole short-term bearish thesis goes out the window and we are targeting 69,232 and beyond. The event that confirms the bearish view? A daily close below 66,805. That's the break of the MA50, and the door to 66,005 and 65,191. Do you think the Nikkei holds above 67,000 this week? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 2 scalp strategies and 1 swing trade. All with exact entries, stops, and targets. Strategy 1, the opening scalp, scalping, high probability, focus, 15-minute structural trigger at the first key intraday level. The setup, we are trading a reversal from the 67,619 pivot point. Price has been ranging between 66,805 and 68,419. The pivot at 67,619 is the equilibrium. The 15-minute chart shows a bearish bias with the MACD trending down, but price is approaching a support zone, trigger condition. I'm looking for a 15-minute bullish hammer or engulfing candle that prints at 67,619 after a test lower. When price taps 67,619 and prints a bullish engulfing on the 15-minute candle, that's our entry, 67,650, 15-minute bullish engulfing after the tap, stop loss, 67,550 take profit 1, 67,850 take profit 2, 68,050 risk, reward, 1:2.0 R for TP1, 1:4.0 R for TP2. What instantly voids the scalp? If the 15-minute candle closes below 67,550, the structure is broken. The logic, the pivot is a psychological level. Institutions are watching it. If we get a rejection bounce with a bullish engulfing pattern, that's a liquidity grab from the stop hunters. The targeting of 67,850 puts us back into the middle of the range. That's a 200-point move with only a 100-point risk. The opening SCALP entry, 67,650, 15M bullish engulfing after pivot tap, stop loss, 67,550 take profit 1. 67,850 take profit 2. 68,050 risk, reward. 1:2.0R, TP1. 1:4.0R, TP2, invalidation. Void if 15M candle closes below 67,550 strategy 2. The liquidity grab, scalping, counter noise. Identify a clear stop-hunt zone just beyond the session high or low. This is where the market makers are going to trigger the retail stops before reversing. Setup. The 68,419 resistance has been tested multiple times. The 15-minute chart shows a sequence of higher lows leading into resistance. Retail traders are placing stops just above 68,419. That's the classic breakout chase, trigger condition. We are looking for a fake breakout above 68,419. When price spikes above a 1, triggers the retail stops, and then immediately reverses, with a bearish engulfing or shooting star candle on the 15-minute, that's our entry, 68,350, short entry after fake breakout and snapback confirmation, stop loss, 68,550 take profit, 67,900 risk, reward, 1:2.25R warning, requires fast execution. This is a 15-minute setup that moves fast. The logic. The buyout news is creating a bullish narrative, but the technicals are overbought. The stop hunters will push price above 68,419, trigger the retail buy stops, then reverse hard. The target at 67,900 puts us at the mid-range, a 450-point move with a 200-point stop, the liquidity. GRAB entry, 68,350, short, fake breakout above 68,419 plus bearish 15M candle, stop loss, 68,550 take profit, 67,900 risk, reward, 1:2.25R invalidation. Void if 15M candle closes above 68,550. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing, trend alignment, based on the 4H daily bias, an entry that captures a multi-session move. The setup. We are trading a bounce from the MA50 at 66,816. The weekly trend is strong buy. The daily trend is sell. But the 4-hour chart is neutral to bullish with the MACD flattening. We need a trigger to align the daily and weekly trigger condition. A 4-hour close above the 60-period moving average on the 4-hour chart, with a bullish MACD cross. That would shift the short-term bias from bearish to neutral, and it would be the first step toward the daily trend reversing entry, 67,200, 4H close above the 60 MA with bullish MACD cross, stop loss, 66,600, below the 50-day MA, take profit 1, 68,500, targeting resistance, take profit 2, 69,500, targeting the 20-day MA, risk and reward, 1:2.6R for TP1, 1:4.1R for TP2 trailing stop rule. Once price reaches halfway to TP1, move stop to break even. Once TP1 is hit, trail the stop using the 4-hour 20-period MA explicit invalidation level. If the daily closes below 66,600, the medium-term outlook shifts to bearish. That would be a break below the 50-day MA and a major shift in structure, entry, 67,200, 4H close above 60 MA plus bullish. MACD cross, stop loss, 66,600 take profit 1, 68,500 take profit 2, 69,500 risk, reward, 1:2.6R, TP1, 1:4.1R, TP2, invalidation. Void if daily close below 66,600. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. I'm risking no more than 0.5% on the scalp entries. No positions through high-impact news, especially BOJ statements or US CPI. Stops are non-negotiable. This is how you survive to trade the next big move. Let's summarize the single most critical level for the next session. 68,419. That resistance is the key. If we close above it on the daily, we are targeting 69,232 and 70,032. But if we reject it and break 66,805, we are looking at a flush to 66,005. The buyout activity is real. The weekly structure is bullish. But this short-term exhaustion is creating a gift for those who trade it correctly. Here's the visual cliffhanger. If this 68,419 level breaks with volume, the whole monthly trend accelerates higher. But if we get a rejection, the liquidation could be fast and brutal. I'll have the updated blueprint 24 hours from now if you want the full breakdown on trading commodities and the Australian dollar, Japanese yen, Eurodollar, and Bitcoin. The videos are live now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.